What is going on, everyone? Welcome back to another live streamed episode of the Sound Money Podcast. If you guys are watching on YouTube, you can not only see my beautiful face, but I have my microphone set up here and my laptop open here. In the past, I've done the stream via my laptop through streaming software, and it wasn't as clear. And I know I got a lot of comments about that actually in the past. So I decided to streamline this a little bit, have my computer open, have my mic set up, have this nice little setup here on my stand with the camera. And I wanted to go over the welcome to the show, everyone, first of all. And thank you so much for subscribing. You guys have been amazing. We're gaining dozens of subscribers every day. It's exciting. And I know you guys are very much interested in some of the more recent content around politics that I've been doing. And I don't really talk very much about politics. I talk about some of the proposed policies that have to do with economics and finance and the economy in general and macro trends around it, not the individual candidates. I try to stay away from that because that can be a dangerous game, getting down that rabbit hole. So I try to stay completely not on either side, left or right. I try to just stay in the middle. And as Andrew Yang says, look forward, not left or right. So that's what I try to do here. I try to just be unbiased, talk about things from an economic perspective, and try to have some fun. So in today's episode, I'm going to talk about this Bloomberg opinion piece. Bloomberg opinion is, once again, an opinion. So one thing that is important when you're going through articles now is, and always, is checking to make sure, okay, is this an opinion or is this a journalist that's reporting facts and so on. So this came out in Bloomberg Opinion by Noah Smith. I believe this was yesterday, the 14th. 5:30 a.m. That's early. And it is in the economics section, which I try to follow best I can in Bloomberg. And it says, France tried soaking the rich. It didn't go well. A wealth tax and sky-high rates on top incomes didn't yield much revenue. So the idea around this is people have been suggesting things like an 80% tax on, the super rich. And some of these things they've been proposed many times by multiple candidates currently on the Democratic side, the left side, going into 2020, like your Bernie and your Elizabeth Warren. They are suggesting these really intense tax on the super rich. And one thing that I want to definitely clarify is when people are talking about net worth and they're talking about income and they're talking about just these taxation numbers, it's very important to keep in mind that a lot of these extremely wealthy people are, for example, in the $1 club where they're paying themselves $1 a year. They're declaring $1 in income. So how do you tax $1 every year in income? So that's just a really important differentiator here, is a lot of these very wealthy people have their wealth in many different assets under different entities that are, whether they're liquid assets or illiquid assets, they're sitting in these assets growing in value in some way, whether that's Bezos with his stock that's worth billions upon billions, that is actually liquid billions, but he's smart enough to know not to do taxable events every year. He's got plenty of investments producing income from various different streams, enough to keep him one of the richest people on earth. And it's important to know that when we're talking about this, there's a big differentiator between income and net worth. And when we're talking about taxing the super wealthy, we're talking about trying to get access to that additional wealth. Like, we're trying to really make sure that these people that are hiding that money, not necessarily hiding, their wealth is in different areas, and they're accumulating massive quantities of it. We need to, as a country, we need to make sure that everybody's paying their fair share. But this article here is about an instance where France went a little too far with their taxing of 10,000 of the wealthiest people in their country, and those 10,000 people left. And what happened was quite astonishing. So let's go through what happened to the economy when these people left. And once again, I'm just saying that this is a capitalist focused perspective that I'm taking here, and it's important to know that we're not in a pure capitalist economy right now. It's like a hybrid version of it, and it is the best of the worst. Like it's working to a certain extent. Obviously, there's some crazy distribution issues that I covered on the podcast on the previous episode. If you haven't seen that, go check that out. I'll link to that in the description below so you guys can check that out, because I go through a lot of why that is, of some of the theories, some of the economist theories the past 100 years or so that have gone over the distribution of outcomes in various ways, especially around creative outlets. When creativity is involved, outcomes are drastically different and move towards a small number of people in the way that it is distributed out. And that's not this episode. This episode is about this article about the wealth tax. Now, Petty has declared this is Piketty, and Piketty is all three embrace the same illusion. Piketty has declared. So this is about people in France. The scholars include Thomas Piketty, author of the best-selling book Capital in the 21st Century, and Emmanuel Saez and Gabriel Zucman, who in the new book chronicle the rise in American wealth inequality. All three embrace the same solution: much higher taxes. So Piketty, one of the authors, the guy who wrote Capital in the 21st Century, declared that billionaires should be taxed out of existence. And he called for a global wealth tax, while Saez, it's S-A-E-Z. Maybe that's Saez? And Zucman helped Democratic presidential candidate Elizabeth Warren design her proposal for a U.S. wealth tax. Also, I'm going to be linking to this below so you guys can check this out, just as FYI. Piketty and Saez have also suggested taxing top incomes at a rate of more than 80%. Other economists have struggled to evaluate dramatic proposals like this. Studies on the effect of taxation when rates are moderate might not be a good guide to what happens when rates are very high. Economic theories tend to make a host of simplifying assumptions that break down under a very high tax regime. That is true. That is very true. Historical experience is of some help because the U.S. had very high top income taxes in the 1950s, but economic conditions could be very different, or they are very different now. So the country tax revenue and social spending looks like in France, it's at 46% was the tax revenue, and 31.2% in 2017 was on social welfare spending. So France, therefore, shows that inequality, at least to some degree, is a choice. Tax and spending really can make a difference, but there's probably a low limit to how much even France can do in this regard. The country has experimented with both wealth taxes and very high top income taxes with disappointing results. France had a wealth tax from 1982 to 1986, and again from 1988 to 2017. The top rate was 1.5% and 1.8%, with a total tax rate on fortunes larger than 13 million euros or 14.3 million euros. And the proposals right now are around, I believe it's 20 or 30 million is what people are proposing. This is much less than the 6% top rate proposed by Warren, not to mention the 8% proposed by her fellow candidate, Senator Bernie Sanders. But it's close to the 2% Warren would impose on fortunes larger than 50. So she's going to impose an additional 2% on 50 million. Wow. The wealth tax might have generated social solidarity, but as a practical matter, it was a disappointment. The revenue it raised was rather paltry. Only a few billion euros at its peak, or about 1% of France's total revenue from all taxes. At least 10,000 wealthy people, this was what I was mentioning earlier, 10,000 wealthy people left the country to avoid paying tax. Most moved to a neighboring Belgium, which has a large French-speaking population. When these individuals left, France lost not only their wealth tax revenue, but their income tax and other taxes as well. French economist Eric Piquet estimates that this ended up costing the French government almost twice as much revenue as the total yield by the wealth tax. So I'm going to read that again. French economist Eric Piquet estimates that this ended up costing the French government almost twice as much revenue as the total yield by the wealth tax. That's a pretty insane statement. So once this happened, all of these 10,000 wealthy people left the country to avoid paying that insane tax that was put on them. And that alone yielded, it literally cost the French government twice, 2x, what the revenue that the total yielded by the wealth tax. Like that is crazy. Those are real numbers there, and that is wild to think about that. And that's called a super tax. So another French experiment was called the super tax, a 75% levy on incomes of more than 1 million euros, introduced by Socialist President Francois Hollande in 2012. The super tax added to the exodus of the wealthy individuals, most notably actor Gerard Depardieu. So a few people exited during the 75% with incomes of more than €1 million. So if you made €1 million every year, you'd have a 75% tax. Now, this whole concept of, everybody paying their fair share, it definitely makes sense. Like I totally agree with that, and I prefaced this entire episode with talking about how it makes perfect sense. But when we're talking about the U.S. economy, and it's a much larger economy here, it's a much larger versus France. The U.S. being drastically larger, and it'll be interesting to see what would happen if, let's say, we do throw an 80% tax on the wealthiest people in America, in the United States, where they would go, or if they would stand there to potentially pay that much in tax. And it's not just for the types of income that you guys are thinking about right now. I mean, I'm not blanket statementing, but it is across the board. We're talking estates, we're talking capital gains, we're talking top incomes, we're talking businesses, corporations, everything. It's a way to get into what I was talking about before, where if you're only paying yourself $1 a year through your business or your employer, technically, if you started Facebook and you're paying yourself $1 a year to your employer, if this tax were to go through, that's everything. Not just that $1 coming from Facebook. That's everything. Okay, capital gains, everything. So there's definitely a lot of interesting theories out there. Now, Andrew Yang, he has proposed one that I'm interested in, which is a value-added tax, and that exists in many other countries. Most of Europe has a VAT, and it is a pretty substantial tax. For example, if you go to a Shopify store that's based in the UK, you'll see that there's an additional value-added tax added on to your purchase, and this is moved through the cost of the good. So when you're paying for the good, it's baked in so that it's competitive with the current landscape in the marketplace. A lot of people consider that a tax on the consumer, and I agree to a certain extent, but in the same way, the business has to stay competitive. And in order to do so, that price, in addition to the VAT, has to come down. Like, they have to drive their price down. So that means more investing in the supply chain, more of the infrastructure to drive their initial price down so that when the VAT is included, they're still competitive across the marketplace. And that is just the basic idea around a VAT and how it equals the playing field. And we get a percentage of every single Amazon transaction, every single Google ad, every Facebook ad, everything that's going through that is producing value. And I think that is a much more effective way than a blanket 80% tax that clearly, in this one example here, triggered 10,000 wealthy people to leave a country and cost the government 2 times more money by doing so. I think that doing something by the transaction, by the value-added tax, is a much more effective way of actually moving that money out of the companies and out of the wealthy into the system, into the government. And that is pretty much my stance on this. I think that 80% tax rate is intense, and it's been proposed before. This is not the first time it's been proposed. I think that there are a lot of ambitious people out there, especially people running for the president, that are shooting for the moon, trying to end up in the stars, where they're trying to say that they're going to get all of these things done to get a lot of attention. But the reality is that it's not all going to get done. And if you do think that it is going to be done in the short period of time that one person is president, you should check history for a little bit. And things are changing. I completely will play my own devil's advocate and say that technology speeds things up rapidly. But there are only a couple candidates out there right now and a couple of economists following this and addressing these issues out there. And I find it really fascinating to follow this because a lot of people are proposing huge. I mean, these aren't small numbers. These are huge numbers here. I think in general, you're dealing with trillions of dollars, like trillions. And if you just think about trillions with a T, you're dealing with a lot of money to the point where it's just such a fundamental misstep when you mistreat $1 trillion. And on top of that, the final point that I wanted to make is this is not good for entrepreneurs when you are basically saying all of the wealthiest people in the world are entrepreneurs. They have started billion-dollar companies, and saying that they're bad, saying you guys are evil, that you should not exist. You should have way less than what you've produced in value to the marketplace. That is a dangerous game. When you can't attract entrepreneurs to your country or to your state or wherever you are, you lose. You lose in general as an economy. If you aren't innovating, you aren't starting businesses, you aren't employing people, you aren't creating jobs, you aren't transacting, distributing consumable goods and services to the economy and the population, you lose. And I think that in this example that I shared with you guys with France, basically after this whole thing happened, they were they were pretty freaked out. that potentially it would be just a wasteland of entrepreneurs. And it even mentions it in this article about just being a complete abysmal place for entrepreneurs to go, because it's like if you go there and you are successful and the market agrees with you and they all love your product and everything that you do, but yet where you are based, the government is rapidly taking this 80% of what you're earning. There's a mismatch there. Now that, as I've mentioned, is the right approach to that. Entrepreneurs can understand that. It's a good competitive edge where if you're able to competitively price and work on your supply chain to make it the economy of scale work for you, then it is a very powerful thing that you can do. And this super tax thing is wild. I love keep saying it just because it is pretty crazy to think that we're talking about this right now. I studied this in school, and it's just crazy to think that this is in conversation as a potential right now. But that is it for this stream and this episode of the Sound Money Podcast. If you guys like it, slap a like on this video and follow if you guys are watching or listening on Spotify or Anchor or iTunes or one of the platforms that this is going to be on. But if you're on YouTube, please slap a like. It helps the channel, helps the podcast. And I will see you guys on the next episode of the Sound Money Podcast. Peace.